Depth is one of the characteristics of the contemporary consumer society, but as prices have risen, Americans have been spending more on necessities than ever before, pushing credit card debt to a record high. According to a survey by the U.S. Census Bureau called the Household Pulse Survey, more than 35% of American households used credit cards or loans to cover expenses in the previous week in December. According to TransUnion's most recent quarterly report, inflation helped push total credit card debt to a record $930.6 billion at the end of 2022, an increase of 18.5% from a year earlier. The average balance increased to $5,800 over the same time period. In this video, we'll discuss the historically high levels of credit card debt in the US. Please subscribe to the channel to receive updates on economic matters. Let's go on to the next section. Last year, people used their credit cards to borrow $180 billion, the most debt ever added in a single year. Additionally, the last 3 months of the year saw the most significant increase in credit card debt ever recorded, with almost $86 billion added during that time. This is a chronic issue overall, where we as a society have gotten more accustomed to using credit for everything, according to WalletHub, a website that aids people in managing their personal finances. Credit cards have become the norm and a way of life for everyone, according to Michael Reynolds, a certified financial planner and the owner of Elevation Financial. Since credit cards allow quick transactions and are convenient, it is not surprising that many Americans owe money on their credit cards. Although 6% might not sound like much, it actually means that 14 million Americans have more than 10 grand in credit card debt. According to her survey by Go Banking Rates, 30% of Americans have debts between $1,000 and $5,000, 15% have debts of $5,000 or more, and approximately 6% have debts of more than $10,000. Unfortunately, a small minority of people, around 3%, feel they will never be able to pay off their credit card debts. Around a quarter of them believe it would take a couple of years, while 5% believe they can do it within 5 years. The quarterly report on household debt and credit by the Federal Reserve is even more alarming because it shows that credit card balances have climbed by $61 billion, surpassing the pre-pandemic peak of $927 billion. Also, a Lending Tree investigation shows that of the 50 states in the United States, Connecticut, New York, and New Jersey are the most in debt. With inflation driving up prices, it's understandable that some people may have accrued debt in the last year. However, if you pay off your debt sooner, you'll save money on interest. Paying off your credit card debt in particular can improve your credit score. However, a recent report by Morgan Stanley found that Rhode Island and Texas have the highest average credit card debt. This decision could ultimately lead to "they are sorry." Unlike what many people believe, it's a trip or a shopping binge, typically. According to Ted Rossman, a prominent industry analyst. Usually something of the bank rate. Incredibly useful and draws you in. But regrettably, it's credit card debt. Both entry and exit are difficult. Bank rate also disclosed some negative information about household financial capacity. They paid up their credit card debt at just before the start of 2022. In America, 50% of people possessed emergency savings beyond the amount owed on credit cards. Because of this, over half of Americans have debt they are unable to pay off. According to economists, there are a number of reasons why the rate of credit card debt is rising. As previously mentioned, the main one is inflation. Credit card holders are spending more money on food, petrol and energy bills as well as rent than they did a year ago. The rate of inflation has been slowly declining for 8 months. In February, prices for goods people buy increased by 6% compared to the same amount a year earlier. This increase is lower than what we saw in January. When we look at core prices, which exclude some items like food and energy, we see a slight decrease from 5.6% in January to 5.5% in February as the Fed increased the interest rates to ease inflation. It affected credit card debt, but it's still significantly higher than the 2% target set by the Fed for the annual inflation. Banks frequently raise the rates they charge consumers when the Federal Reserve raises its rate, which impacts variable rate credit card debt and makes it more expensive if you always pay off your credit card account in full. You don't need to worry about it, but if you have a balance on your credit card and especially if you only pay the minimum amount due, you'll end up paying more money in interest each month, and it will also take you longer to pay off what you owe given that inflation is expected to last for quite some time. For example, in November of last year, the Fed increased interest rates to combat inflation, but they've also made it harder for more people to pay off their debt. The second reason credit card debt is so prevalent is due to the new benefits that businesses are introducing. For instance, DoorDash and Chase have launched a new rewards credit card for customers who use DoorDash frequently. If you have the card, you can receive benefits like 4% cash back on DoorDash and Caviar orders, a free 1-year subscription to Dash Pass, and $100 cash back after spending $500. But keep in mind that borrowing money has a cost, the federal residuum. However, if you can't pay off your balance each month, you risk paying a lot more in interest. Keep in mind as well that the DoorDash Chase cards are not interest-free. The range of the APR is 19.49 to 28.24%. According to the Brookings Institution, revolving credit card debt might have devastating effects on borrowers. An estimated $111 billion in interest and fees were owed by almost 50% of American families with credit card debt in 2021. This sum is approximately the same as the total interest paid by households on vehicle loans and leases. In addition, a sizable portion of those with credit card debt have a tendency to carry it for an extended period of time, which can prohibit them from using their credit limit for savings. They might not be able to obtain less expensive forms of long-term financing if they are unable to pay it back. Lastly, the younger generation is progressively paying for everything they buy with credit card debt. In spite of the fact that many of them are truly worried about the prices, nearly half of the Millennial and Gen X respondents to a survey of credit card debt that is larger than their savings or money set aside for unforeseen expenses. According to Lance DeJesus, a 46-year-old kitchen manager at the Golden Corral in York, rising petrol and food prices are a result of the economy. I now leave the grocery shop with just one bag, whereas you could go there with $100 and leave with a number of bags. According to the LA Times, he also disclosed that he uses various credit cards with interest rates ranging from 16.99% to 21.99% to carry a monthly load of about $2,600. Additionally, according to Bloomberg, borrowers under 30 are the only ones seeing an increase in past due accounts that could harm their credit scores. As a result, if the current rate of inflation is not controlled and borrowers don't start using their credit card debts more responsibly, disaster is inevitable. Thank you for watching, and please feel free to comment on the growing credit card issue in the country.